In a disconcerting turn of events, the Eurozone's inflation rate defied expectations and climbed for the first time this year, reaching 2.6% in May. This uptick casts a shadow over the hopes of investors and policymakers who anticipated the European Central Bank, ECB, would aggressively slash interest rates in the coming months. The data unveiled on Friday underscores the intricate challenge confronting the ECB as it navigates the delicate balance between curbing inflation and fostering economic growth. The slight increase from April's 2.4% rate, while seemingly modest, exceeded economists' forecasts and sent ripples through financial markets. The core inflation rate, which strips out volatile energy and food prices to provide a clearer picture of underlying price pressures, accelerated from 2.7% to 2.9%, further complicating the ECB's policy deliberations. Until May, Eurozone inflation had been on a gentle downward trajectory, aligning with the ECB's 2% target and setting the stage for policymakers to confidently signal their intention to commence cutting the benchmark interest rate from its record high of 4% as early as next week. However, the resurgence of inflationary pressures has cast doubt on the ECB's ability to maintain an aggressive easing stance throughout the year. The immediate reaction in the bond market was palpable, with the yield on Germany's 10-year bonds, a benchmark for Eurozone borrowing costs, surging to 2.7%, its highest level in over 6 months. Financial markets now anticipate a more cautious approach from the ECB in lowering rates for the remainder of 2023. As the central bank grapples with the delicate balance between addressing inflation and supporting economic growth. While the ECB is still widely expected to proceed with the anticipated rate cut next week, effectively becoming the first major central bank to ease monetary policy since the global inflation surge began 3 years ago, the recent uptick in price pressures has introduced a new layer of uncertainty. Jack Allen Reynolds, an economist at Capital Economics, opined that while the inflation jump won't stop the ECB from cutting interest rates next week, it has rendered another reduction in July unlikely. This sentiment echoes the growing consensus among investors and analysts that the ECB's path forward may be more gradual and measured than initially anticipated. ECB chief economist Philip Lane acknowledged this challenge earlier this month in an interview with the Financial Times, stating that barring major surprises, the central bank was poised to remove the highest level of policy restriction at its forthcoming meeting in Frankfurt. However, he cautioned that the pace of further cuts would hinge on the trajectory of underlying inflation and the level of demand, which he warned was likely to be bumpy and gradual. The May inflation data was buoyed by a notable shift in energy price growth, which turned positive for the first time in over a year at 0.3%. This development has fueled concerns among some policymakers that higher inflation readings could dissuade the ECB from implementing back-to-back rate cuts in July, a scenario that financial markets had priced in as a possibility, envisioning between 2 and 3 0.25 percentage point reductions this year. The ECB's forecasts hinge on the expectation that Eurozone wage growth will decelerate from recent record highs and that companies will absorb higher labor costs by compressing profit margins rather than passing them on to consumers via price increases. This dynamic will be crucial in determining how swiftly inflation in the labor-intensive services sector subsides over the course of the year. In May, Eurozone services inflation rose to a 7-month high of 4.1%. Up from 3.7% a month earlier. However, some economists attribute the recent rise in services inflation to one-off factors, such as the earlier timing of Easter this year and the fading disinflationary impact of Germany's discounted public transport ticket. Diego Iscaro, an economist at S&P Global Market Intelligence, expressed caution, stating, "The rise in service price inflation is not a welcome development," but added that he would await detailed data to ascertain if the end of German transport subsidies was the main culprit or if there were other factors boosting service prices. Amidst these inflationary pressures, there are signs that consumers remain cautious, despite their purchasing power being bolstered by wages rising faster than inflation this year. German retail sales fell 1.2% in April from the previous month, while French retail sales declined 0.8% over the same period, underscoring the lingering uncertainty and restraint among households. As the ECB convenes next week, it finds itself at a crossroads, weighing the imperative to rein in inflation against the need to nurture the Eurozone's fragile economic recovery. The recent resurgence of price pressures has undoubtedly complicated the central bank's deliberations, forcing policymakers to strike a delicate balance between decisive action and prudent caution. In a landscape where inflation's specter continues to loom, the ECB's forthcoming decisions will reverberate across the Eurozone, shaping the trajectory of economic growth, consumer confidence, and the broader financial landscape. As the world watches with bated breath, the central bank's ability to navigate this intricate challenge will be a litmus test for its commitment to price stability and its deft management of monetary policy in an era of unprecedented uncertainty.